听点资本本期视频为您带来的是摩根大通在3月21日关于关税如何影响外汇市场的观点。首先，最受瞩目的当属4月2日白宫即将发布的关税公告，这不仅牵动了全球市场神经，也让美元走势暂时止住了下行势头。市场对关税政策的不确定性充满期待，尤其是互助关税、行业关税和边境调节税等可能性可能会如何影响外汇市场，我们拭目以待。专家们也在热议各国央行可能采取的应对措施。这场关税博弈无疑是眼下最大的看点。接着，我们把目光转向欧洲。本周，英格兰银行、瑞典央行和瑞士国家银行相继公布最新决策，英镑、瑞典克朗和瑞士法郎的走势各有看点。比如，英格兰银行意外的投票结果透露出内部的不确定性，而瑞士央行降息则引发了对避险货币的新思考。下周，挪威央行的会议也备受关注，市场预测他们可能按兵不动，甚至略偏鹰派，这或许会给挪威克朗带来短期支撑。此外，土耳其本地市场正面临压力，可能是受到新兴市场整体疲软的拖累。美国实际收益率企稳则为全球市场注入一丝稳定。日本国内局势让日元涨势停滞，这些因素交织在一起，影响着全球资金流向。人民币中间价的上调也为市场增添了新变量。接下来是英文会议的全部内容。如果您需要英文原稿和我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Hello and welcome to this At Any Rate podcast. I'm your host, Arindam Sandilia, and I'm joined today by my colleagues in FX Strategy, James Nelligan and Patrick Locke. It seems we are stuck in macro markets. It's not just FX, it's almost everywhere. People seem like they're paralyzed by this impending April 2nd deadline for the big tariff announcements out of the White House. It is then perhaps not surprising that the dollar downtrend has taken a bit of a breather this week. We've also had a series of idiosyncratic developments. There's been some anticipation in FX circles about month-end and quarter-end equity rebalancing that could entail a sizable amount of euro buying. There's been some stress in Turkish local markets that seems to have come on the back of weakness in a few other high-yielding EMs. U.S. real yields have stabilized a little bit of late. There's been some local Japanese developments that seem to have stalled the yen rally. And if you squint hard enough, you can see an uptick in CNY fixing. So add all of that up. I think you've enough there to at least temporarily arrest the momentum in this DXY bear trend. But I think the bigger story here is just this plain vanilla de-risking ahead of a very critical tariff event risk that's coming up in a week or so. So why don't we zero in on that and start there? Pat, obviously, tariff-related questions are the ones that are coming through from investors in bulk these days. You've looked at tariff-related scenarios more closely than perhaps anyone else on the team. Your take on how you feel these scenarios are shaping up now, what might happen, just your take on this whole situation.
Yeah, thanks, Arindam. I agree with your point that these conversations and kind of the tactical risk management around that April 2nd date really did spike this week, both in terms of inbound questions and, when I was around town in London meeting with clients, that was kind of like the singular uniting thread, I would say, across, each of the discussions. What exactly is going to be delivered, what the dollar impact is. And obviously it's, we have to discuss these things with a certain degree of humility, both because of the inherent, unpredictability of tariffs. In this particular instance, the various different sleeves or channels through which tariffs could be delivered, and then of course, obviously the dollar price action that has gone against some expectations around how tariff delivery would go so far this year, right? So, I say all these things with a certain degree of humility here, but look, I mean, at the end of the day, I think there's a number of different things that are going to come across the board April 1st and April 2nd. The focus has been generally on reciprocal tariffs and sectoral tariffs. But of course, there's the VAT wildcard, the end of the second 1 month deferral of USMCA tariffs is due to expire in early April. So those could, in theory, ratchet. There's ongoing discussion, potentially, the universal tariffs. And then there's a number of China-linked investigations, the 301, the Phase 1 renewal, MFN, permanent normal trade relations status, all those things are also being reviewed. So obviously, like, you step back, there's a lot of permutations about what could actually kind of be delivered here. And it's hard, to really kind of have an exact, precise base case of what tariffs might be delivered, what will not. We can say a couple things, though, I think, in terms of delivery. It seems like, from a legality standpoint, my sense is still that, the sectoral tariffs would be most likely to be applied by a Section 232. I think, and those ostensibly have investigative links, meaning that could be kind of a multi-month process before they actually get implemented. Steel and aluminum, of course, this time around were able to be introduced immediately, but that was in part because we already had a Section 232 investigation in the first Trump administration. But stuff for like semiconductors, pharma, I do wonder if there would be more of like an elongated implementation process on those. So those would be, obviously material in a lot of different respects. But I do wonder about the timing. I feel like reciprocal tariffs might have a potentially like a higher odds of being implemented on the early side. Again, not exactly sure, but I think that's kind of my sense, at least relative to the sectoral ones. And then the VAT remains a wild card as well. VAT and reciprocal are also the most likely to be negotiated in some form on a bilateral basis. And official commentary over the last week or two does seem to suggest that there is a degree of flexibility there. So it all kind of like continues to create this haze of uncertainty around what is going to be delivered, what is the staying power of each decision, and all that. In terms of calibrating what the FX response ultimately is, I mean, I think right now there's a fairly healthy debate, in no small part because obviously the dollar is weaker year to date, despite some reasonably material tariffs being delivered against China, and technically net tariffs, the effective tariff rate on Canada and Mexico also haven't gone up, even if it's fallen short of the 25%. We obviously, I think, one lesson learned is obviously that the blowback to the U.S., in part because of the USMCA tariffs, but, it has been greater than I think what most market participants had been expecting coming into the year. And I think naturally that should somewhat water down or dilute the beta that you would expect from kind of the tariff pass-through to the FX space. But what I would say is that I think at the end of the day, we still think tariffs are a net dollar positive, right? I think there's still kind of like tariff 101 considerations in terms of, competitiveness adjustments, shock absorbing impact of FX for exporters, relative price change in terms of real effective exchange rates. All those still continue to point to the fact that, the dollar should be stronger, FX to the extent that tariffs are delivered. I'd make the point as well that, at least in our area of coverage, G10, CAD is the only one to have been tariffed so far this year and is a very clear underperformer so far year to date. So that inherently makes sense, even if, the delivery has been erratic, highly uncertain against a backdrop of a broader dollar weaker environment. The question really then becomes, what kind of dollar environment is it? Is it explosive? Or is it more of kind of the bifurcated, maybe, like dollar weaker against yen, but perhaps can still outperform the high beta and EM complex? That'll ultimately depend on the nature of the delivery. My personal view is that the VAT would be more of a Big Bang style kind of delivery, kind of going back to that global supply shock kind of environment. That to me has always been inherently a dollar stronger environment, dollar correlations up, dollar up kind of like in a broad sense. But I admit too that there's definitely going to be some repercussions for the US itself in that case. In this instance, I still think kind of like the dollar up impulse is liable to win out, especially in the context of, current positioning relative to, let's say, mid-January when everybody was long dollars, the dollar was overshooting fair value more obviously. Feels like the slate is a little bit cleaner now. in which case you won't be fighting kind of that like technical deleveraging, risk premium adjustment flows, that kind of thing, which we saw kind of throughout February, which I think might have like exaggerated the extent of dollar weakness a little bit more in the context of tariffs actually having been delivered. So, but yeah, like I said, I think people certainly gearing up for the April 2nd dates. The price action midweek did seem to feel like, you know, in the context of these questions kind of collating all together, that maybe there was some kind of like, you know, position squaring and things like that. People starting to get ahead of this a little bit. And so that's kind of how I'm seeing it at this point.
Yeah, I think I agree with almost all your characterization of those scenarios. My personal bias is that the 2018-19 tariff betas will be quite substantially haircut this time around. You mentioned the blowback effect on the U.S. I think that's a big one, but also the fact that policymakers in trade partner countries will be better prepared to deploy counter-cyclical policy tools faster than they did in the last cycle. And the fact that we've already seen Canada retaliate, and if you get retaliation on a broader basis, then just in theory that reduces pressures on the exchange rate to adjust. And I think what the PBOC does in this climate, I think, is also going to be extremely vital to the overall fate of the dollar, right? Because, so far they've not allowed the CNY fixing to move. I do not think that we should entirely extrapolate their recent behavior into the future. But I can see the case for them continuing to hold the line on the currency, let's say keep dollar CNY somewhere below 730 or thereabouts, while presumably back channel talks continue around some sort of a presidential summit or the beginnings of a negotiation or something along those lines, right? So if the PBOC reaction function is more diluted than was the case last time, then it's possible that the tariff elasticities that we saw last time don't repeat nearly to the same extent. But fully agree with you that markets may have been lulled into a sense of complacency based on the last 2 months of price action. And what one lesson from this year is that starting points matter, exactly as you said. And because that starting point is a lot cleaner, then at least for the more extreme scenarios, we should be a little more cautious about what that might mean for both the dollar and risk markets. As is always the case, I think the extremes of the distribution are probably a little easier to get one's head around. Your VAT matching tariff scenario, what you describe as a big bang. I don't know if I had to put numbers on it, and these don't fall out of a specific model or anything, but in my head, maybe you can get on a multi-week basis, 3 to 5% dollar upside on an index basis, whereas the most benign outcome for risk is this vanilla reciprocal tariff, in which case, because markets think they can be negotiated away. It might not be a big deal for the dollar. It's pretty benign for risk, as close as you can get to the middle of the dollar smile. And the dollar can be, 2-3% weaker in that world over a similar sort of time horizon. I think in your big bang scenario, certainly there will be people who disagree with the characterization of the dollar. They probably feel the dollar weakens a lot more. I think where you won't have much disagreement is that it is bad for risk, and your Swiss crosses and the yen crosses, your typical high beta responders in risk off, I think, will be in play, and they might be some of the better places to hide in terms of navigating this climate. The in betweens are harder. Feel like universal 10% is not good for risk, but maybe it's a watered down version of your big bang VAT. USMCA focus tariff that's bad for CAD and MEX narrowly is basically the North American bloc flirts with recession. But the broader dollar index ramifications are questionable. Sectoral is kind of similar in that it probably means a whole lot more for Asia if semiconductors fall within the ambit of sectoral. But sectoral also has potentially delayed implementation, in which case the immediate market impact may not be massive. What I do not want to do, and this is the last thing I'll say, is think about the possibilities in terms of how various sorts of tariffs can be stacked on top of each other, and then how you cross out those possibilities against when the implementation of these tariffs start. I mean, several people feel like that I've spoken to feel like they could start on day one, but there's a case to be made that they could start on a deferred basis as well, in which case the possibilities are endless, and I don't think my brain can handle the combinations that fall out of that. So let's work with those few basic ones. At least we've set out some guardrails in terms of what the extreme market reactions could be. Pretty sure that we're going to get something that may not entirely hew to the script, but that's not a bad starting point. So just pivoting away from tariffs for a minute, shall we just talk about the Fed? This was a quarterly SEP, FOMC. Usually these are pretty big deals for markets, but markets seem to have shrugged the whole thing off. So Pat, your take on this? Is there really nothing to see here, or were there little bits and pieces here and there that we should keep in mind as we look forward to the Fed for the rest of the year?
Yeah, thanks, Surinder. Look, I think all the SEP revisions are always extremely informative, but I think just taking a step back, the question is, did the Fed give us any indication that either side of the dual mandate has changed significantly in a way that will obviously portend a more obvious shift in policy that would be more obviously dollar bullish or dollar bearish? And the bottom line, I think, is no. Again, like going back to the SEP specifically, and in the context of the dual mandate, you revise up the U rate, you revise up core PCE, both of which, fairly materially. The net effect is, an unchanged median dot. There's not a whole lot to do necessarily from that. Again, unless like the Fed gives you like a very clear skew of like where their concern actually lies. But uncertainty spiked on both their activity kind of side of the ledger, and uncertainty also spiked on the inflation side of the SEP ledger. So really for me, that's kind of like you have that dichotomous shift that they don't like. You call it stagflationary, I guess. But uncertainty is obviously heightened. They made that clear in the statement. And I thought it was interesting in Mike Feroli's write-up that basically they're still looking for 2 cuts, but the risk is that it's both A, delayed from our June start, and B, biased towards more easing. So that gives you kind of like a sense of just kind of how unusual this net set of SEP revisions really kind of was. So from that, I don't think there was a whole lot for the market to really kind of sink its teeth into with some kind of like high degree of conviction to take, risk substantially one way or the other. At the end of the day, I think, Powell's description of the economy and inflation being transitory, was again a relatively overall benign assessment. I would say it probably his assessment was probably skewing dovish. I think that's broadly consistent with them not quite abandoning their asymmetric dovish reaction function. But again, like no obvious delta really in that. It's kind of just like a reiteration of existing kind of framework. And so in that case, again, not a whole lot for the dollar to do there. The last thing I'd say is like maybe I think you made a good point in your preview, that we put out that day, is that technically the net unchanged median in the context of a higher core PCE revision is implicitly a lower real policy rate forecast, right? And I do think that kind of matters when you overlay that against kind of the Powell's relatively just sanguine view of things, given the degree of uncertainty. Wasn't entirely surprising to see it yields move lower and they kind of stayed lower. But again, that's not enough necessarily to think that this Fed meeting changes the kind of the 1 to 3 month trajectory of the dollar. And in that case, setting aside the tariff question for a second, we are still generally looking for a degree of ongoing U.S. moderation against obviously like a big sea change in Europe's organic growth via the kind of like exogenous shock from the fiscal policy. So that's a very long-winded way of saying that we're not changing. I don't think anything in the dollar view necessarily on that. Yeah.
All right. James, just turning to you now and staying within this relatively comfortable cocoon of central bank meetings away from the messiness of tariffs. You got a bunch of central bank meetings in Europe this week, Bank of England, SNB, Riksbank. You got one coming up next week as well, Norges. So just your broad takeaways on these central bank meetings. What should we look forward to next week? Anything material for the Norway? And broadly, what are you thinking about the European FX space at this point?
Yeah. Quickly just running through the central banks from this week. I mean, the surprise from the BOE was on the vote. You had an 8-1 vote instead of 7-2, which we were expecting. Mann withdrawing her dissent, and Dingra voting for 25 basis points instead of 50. But you didn't really see much sterling strength on the back of that. You've got a Bank of England that's trying to balance weaker growth, stronger inflation. There's a lot more uncertainty, it looks like, on the MPC now. But I think, part of the reason why sterling strength was capped on that is because you do have the OBR forecast update next week. So we're seeing a 10 billion undershoot on the headroom, and potentially about 0.5% of GDP of fiscal tightening over 5 years, which isn't. It's not huge, but let's not forget that, in last year's budget, the Labour government delivered something that was wildly different to market expectations going into the event. So we think that justifies some risk premium in euro sterling, and it's currently trading actually cheap to fair value. So, there's some tactical risk going into the event there. More medium term, you've got to navigate those tariff dates, but more medium term, we do think that there is a European underallocation theme that can drive euro strength in some of these European crosses. For the Riksbank, it wasn't much to see really. The rate path was left unchanged. They do see the kind of basket effect on CPI as something that's going to normalize, pretty much in line with our economist forecasts. So definitely a view of transitory there from the Riksbank. And really the story for Stocky continues to be one of equity rotation, Riksbank easing, still supporting growth. And so we do think Stocky can continue to do well, but obviously, as with the other currencies, we do need to navigate those tariff dates. S&B did cut rates. We were a bit, on the fence almost. You could see arguments both ways, but they did cut rates, and interestingly, they did actually flag the downside risks to sentiment, to growth and inflation, despite kind of nudging up the near-term inflation forecasts. And you're left there with a terminal rate that's still around 20 basis points. So there's definitely not much priced in terms of factoring in that dovish S&B bias. So, we'd be biased to think that terminal can head lower and weaken Swiss. But obviously, as you say, Arindam, Swiss crosses are going to be some of the more sensitive to the tariff developments over the next few weeks. So if we can kind of navigate through that, we still do think medium term, as I said, that there is a euro underallocation theme that can help euro Swiss higher. And then, as you say, Norges Bank next week. It's become a lot more debatable now after the stronger inflation print and yesterday's strong regional network survey. So we actually think that they're going to hold now. Instead of cut, and the rate path is going to go up a pretty decent amount, almost 40 basis points on the back of the data. So you could even argue it's a bit of a hawkish hold. But there's two angles there. You've got, as we saw in Sweden, in a very levered private economy, central bank easing is not necessarily bad for the currency because it supports growth over the medium term. But over the short term, you can get some tactical support for NOK if, as the rate cut expectations get pared back. So that probably sounds like we're trying to talk out of both sides of our mouth and trying to have the cake and eat it. But, I think the kind of short term and medium term implications are slightly different for NOK when you think it's a very similar vein to Stocky. But NOK is a currency that we do see as very much the laggard in the European space after Stocky's done very well. And And we've been pushing quite strongly this idea that you can see NOK start to catch up to European cyclical repricing, US moderation, the equity rotation, carry to value rotation. So we have a pretty aggressive Q1 26 forecast for Euro NOK of 10.50. I think, and just thinking about the risks over the next few weeks as well, we did a lot of work in November on tariff exposure. And if you look at NOK, it's got one of the lowest manufacturing shares. You could argue it's a bit more isolated from tariff risks. And the regional network survey yesterday, actually the contacts mentioned that they don't expect trade uncertainty to impact domestic activity in the first half of the year, which really, I think, highlights, that there is some genuine tariff isolation there. So that's a currency we do quite like at the moment.
Okay, brilliant. Let's leave it there for this week. Thanks very much for listening in. This communication is provided for information purposes only. Please refer to JP Morgan research reports related to its content for more information, including important disclosures. 2025, JP Morgan Chase & Company, all rights reserved. This episode was recorded on March 21, 2025.